Hello, everyone, and welcome to the launch of OMFIF's Global Public Investor 2021. We have a lot of people joining us from around the world, over 300 people joining us right now across Asia, from Middle East, from Africa, from Europe, of course, and also from the Americas. Many of you, I think, from the global public investor community joining us today to hopefully, I think, hear what your peers are doing at these times of extraordinary challenge and change. And that's what we'll be focusing on during the course of the next couple of hours. Today, really, we're asking a $42.7 trillion question. That's the number of assets under management in the 850 global public investors that OMFIF has researched this year as part of the GPI. That's up from 750 that we had last year. We know that a group of investors with this firepower, even small changes in the way that they're accessing the market, can have big impacts. But we're seeing even more than that this year. We're seeing some fundamental changes that we think are accelerated by lower for longer and accelerated, of course, by COVID-19. One of the biggest trends we're seeing now, of course, is diversification, often just to maintain current levels. In many cases, we're seeing a big rise in the sustainability agenda. We're seeing changing attitudes towards reserve currencies. We're seeing allocations to riskier asset classes. And today we'll also ask the fundamental question of what are reserves actually for. Before we get started, I'll just whet your appetite with a couple of things that we'll reveal later. 75% of central bank reserve managers think that monetary policy is having an excessive influence on market pricing. 40% of public pension funds fear their peers are taking on too much risk. And 70% of central banks plan to increase their holdings of renminbi over the long term. That hopefully whets your appetite a little bit for what we have ahead. Over the next 90 minutes, of course, we will explore those much more deeply. At the end of the session today, we'll have a panel discussion with reserve managers and some of their advisors talking about the key findings and the key trends and challenges that they face. My colleague Pierre Ortlieb will talk you through some of the key findings of the report. In a moment, we'll go to our keynote conversation, which is with Jean-Claude Trichet, the former president of the European Central Bank. But for now, a few introductory remarks, please, from Marcus Pratch. Marcus is the head of sustainable bonds and finance at DZ Bank. DZ Bank, one of our partners today, alongside Amundi and BNY Mellon in the launch of the GPI. So Marcus, over to you.
Dear Clive, dear Mr. Trichet, dear economic and political leaders, distinguished guests, ladies and gentlemen, and friends of OMFIF at DZ Bank, good afternoon. It gives me immense pleasure to welcome you all to this year's OMFIF Global Public Investor Virtual Launch event. Ladies and gentlemen, last year, in the blink of an eye, the pandemic has turned our daily life upside down and has presented central banks with a major challenge that they have mastered in an exemplary manner. The abruptness and speed of the economic deterioration, the sharp increase in market volatility, and the blinding uncertainty about the impact of COVID-19 in an environment of already low inflation motivated a central bank reaction that was unprecedented in terms of speed, scope, and size. Without the timely, coordinated, counter-cyclical, and massive policy response to Corona by fiscal and monetary authorities around the globe, the downturn could have been much worse. Now we have to look ahead, which is by no means going to be easier. History shows that managing the exit is not going to be a walk in the park. The ongoing transition to the post-COVID-19 phase of central bank policy will be a crucial test for the global recovery and markets. Move too fast and central banks risk shaking investors, hurting confidence, and stalling the rebound. Going too slow and central banks could fuel inflation and worsen financial stability as prices surge. One thing, however, is unquestionable. The post-COVID-19 era should be seen as an historic opportunity by all market participants to build a more sustainable tomorrow rather than simply rebuilding yesterday. The post-pandemic world can be more inclusive, greener, and more sustainable than the one we know. It is up to us to build back better together. Central banks are an important player in facilitating the sustainable and inclusive recovery by living a new credo: liquidity, safety, return, and sustainability. Given their advisory role in politics and their perceived role as anchor investors, they serve as important catalysts for further growth of sustainable finance. Sustainability risks are a significant threat to global financial stability. Hence, more and more central banks are incorporating ESG considerations into their policy frameworks, including their reserve management. Furthermore, they engage with the financial private sector to develop new instruments to accelerate the transitions toward a sustainable future. This is encouraging, as the decisions we make today and in the coming decade will determine our future and the future of our children, our grandchildren, and the generations to come. There is no plan B, there is no planet B. I'm confident the engaging agenda of this virtual event will facilitate a stimulating exchange of views, opinions, and thoughts. I wish the discussion all success and us all great strength and health to tackle the challenges ahead. Thank you very much.
Thank you very much to Marcus for those important words. It's no surprise that our report is called Headfirst into the Post-Pandemic Era. That feels like where we're going, but I think in a constructive way. Now let's, without further ado, move on to our keynote address. This is the former governor of the European Central Bank, president of the European Central Bank, Jean-Claude Trichet, in conversation with OMFIF's chairman, David Marsh. So David, over to you.
Good day, everybody. My name is David Marsh. I'm the chairman of OMFIF, and it is a great pleasure to be joined today by Jean-Claude Trichet, the former president of the European Central Bank, former governor of the Banque de France. He was also for many years the head of the French Treasury, and he's been very active in the years since he stepped down as being the head of the European Central Bank in debating, commenting, and also making some decisions on world economic and monetary affairs. Still very active, even though he's no longer at the ECB. And he is the quintessential person to talk about some of the findings in our survey. So welcome, Jean-Claude. Thank you very much for being with us today. Could I start off, please, on the renminbi? Our survey this year shows a very impressive pickup in the number of central banks that want to purchase the renminbi and use the renminbi as a reserve currency. Particularly in Africa, we find this a very big subject. Do you think the renminbi now has come of age in a way as a reserve currency? And also, do you think it's possible for the renminbi to continue to grow in importance at a time when there is a lot of geopolitical confrontation, particularly with the United States?
Thank you very much for your invitation, David. It's a pleasure, always a pleasure to be with you. And let me say that I appreciate enormously your first question, because it goes without saying that China is occupying a major part in the global economy and very rapidly expanding. It's a bizarre way that the renminbi remains at a very low level, obviously, in the currency composition of official foreign reserve assets. It's only 2.5%, according to my last figures, compared to dollar 59% and the euro 21%. So it's minuscule. And of course, it's going to increase a lot. There is no doubt for me. I'm not surprised by the results of your survey. They are clearly demonstrating that the trend, the derivative for the renminbi is, of course, a very high one. It's overdue, if I may, in some respect. But the problem remains because the renminbi is not yet a really fully convertible currency. So I expect at the moment the renminbi becomes a fully convertible currency, a big jump ahead. This is, as you know, called for by a number of Chinese friends, including the former governor of the central bank, Xiaoshuan Zhu, calling for full liberalization of the renminbi. It will come, and when it comes, as I just said, we will see the materialization of your survey in real figures.
Do you think, though, that the United States problems are going to hold the Chinese back?
No, I don't think that the quarrel between the US and China, if it remains at the present level, will prevent the renminbi to augment its presence and its overall, I would say, global reach. Clearly, as you know, at the moment we are speaking, despite the quarrels, the coupling between the US economy and the Chinese economy remains extremely important. And a lot of US firms have their own products manufactured in China at the present moment. And I take it that unless there is an absolute catastrophe with the materialization of the quarrel in the terms of military action, unless you have that, normally it seems to me that we should continue to have some kind of, I would say, coexistence of both economy. And again, the Chinese economy is playing a very important role in the world, will continue to play a very important role, an increasing role, obviously. And I take it that the renminbi will follow normally, and again, provided it is a fully convertible currency.
Thank you for making that point about convertibility. I'd like to turn on to the question of sustainable assets. All this has been given even greater prominence by the devastating floods in Germany and other parts of Northwest Europe in the last few days, which most politicians now do blame on global warming. We see in our survey that 92% of central banks already invest in green bonds, and there's quite a majority who say they're going to continue that. There's also a lot of interest in sustainable equities. Do you think now, Jean-Claude, that sustainable performance and criteria for sustainable performance has now become like a fourth reason why central banks should invest in assets which are thought of as reserve assets next to the traditional attributes of safety and reliability and liquidity and, of course, a certain return? Has sustainability now become the fourth criterion for reserve assets?
First of all, let me echo what you said on what happened in Germany and in Belgium with all the fatalities. It is another wake-up call for all of us on the planet to understand that climate change is a very, very, very important issue, and that we have to mobilize all possible resources and energy to cope with it. So from that standpoint, of course, it's good that we have a consensus now at a global level with the change of the US administration. As regards central banks, as you know, the ECB has been very, very keen on being as active as possible. And the action plan of the ECB, which was just published, puts climate change consideration at the heart, not only at the heart of the own funds, portfolio investments, which some were arguing for, but at the heart also of the monetary policy devices, including collateral, including the purchase of tradable securities, corporate securities. And that is, of course, something which it seems to me will be followed by most central banks of the world, to the extent, of course, that they do not hamper their first mandate, the primary mandate in most countries being to ensure price stability. And in the case of Europe, it's very clear. The treaty is there. The ECB said we will, of course, respectfully follow the treaty with great determination. Price stability is our primary mandate. That being said, we have also to follow and back up what has been decided by the European, and as you know, the Green Deal in Europe is also something which is very important. And the treaty says, provided you don't hamper price stability, you can support the other policies of the European Union. And it seems to me that what the ECB has decided, I understand on a unanimity basis, goes in this direction, and as you suggested, is part of a very important move of central banks in that direction.
And this applies to the reserve assets as well, would you say?
Yeah. It normally applies, as far as I understand. But some were saying, let's have the sanctuary of monetary policy not being touched, because monetary policy is monetary policy, and let's concentrate on the own funds, on the investment, the portfolio investment, the reserve investment of the central banks. All taken into account. After due meditation, they decided not to make that difference, not to make that split, and to embark on something which is comprehensive along all the spectrum of action of the central bank.
It is a holistic policy, but some central bankers, and Jens Weidmann from the Bundesbank has been among those in the past, have said that if central banks go too far down the line of supporting the political dimension of fighting climate change, this will somehow interrupt their operations based on price stability and could also affect their independence. Do you think there's any water in those arguments?
Well, first of all, I have to say myself, when I had hearings with the European Parliament, I was making the distinction between the investment, the portfolio investment on the one hand, the reserve investment on the one hand, and the monetary policy on the other hand. It finally has been decided not to make that difference. I understand that. It was not my first move, I have to say, but I understand that. And of course, provided you're very clear that your primary mandate is holy. I think it's extremely important for the credibility of the central bank, for the credibility of the ECB. It is said very, very clearly, and it is probably the reason why I understand there was unanimity in taking the decision.
So there has been something of a conversion, I think, not just by yourself, but I think by other
Sure.
in that regard. Another part of the survey spoke about reserve currency diversification. We had something like 18% of the respondents saying that they intend to reduce their euro holdings over the next 12 to 24 months. 20% said the same thing regarding the dollar. So there doesn't seem to be a particular pattern to this. What do findings like this tell us about the general desire for reserve currency diversification?
If you take the perspective of the last 20 years, I would say it's very clear that you have a trend. The trend is that the dollar was representing as a proportion of the reserves assets 71% in 2000. Today, in 2020, because we have the figures of the last quarter of last year, 59%. So minus 12% for the US dollar. So this is a trend. It means that other currencies are taking their own share, additional share in the reserve assets. For the euro, it's plus 3%. We came from 18.3 to 21.2, so plus 3%. So you see something in the long run, in the 20 years of the existence of the euro, something like a slight diminishing of the US dollar proportion, a very slight augmentation of the euro. As regards the yen, there is no change. As regards the sterling, it augmented significantly. As regards the Canadian dollar, Australian dollar, it augmented also. And that explains why the US could diminish by 12%, because you have Canadian dollars, Australian dollars, sterling a little bit, and of course the renminbi. Renminbi came from 0 to 2.25, and we are expecting, of course, that the renminbi, we already said that, will continue to augment as a proportion. So that is the trend. We will see where it stabilizes. I would say that I don't call for dramatic changes. I think that any dramatic change would be to the detriment of all partners. If the euro, for instance, is picking up massively, of course it would augment the value of the euro on the exchange market. It's not necessarily what is to be expected in the present situation of the European economy, and the same for other currencies. If the dollar is falling down precipitously, then it would be very bad also for the entire world and for the US. So I would say organized, progressive, orderly changes are probably of the essence. And it is more or less what we have observed over the last 20 years.
66% of the respondents say that they expect the new assets to be issued by the European Commission as part of the next generation EU deal to become a permanent part of their portfolios. Does this tell us that the European safe asset has now arrived? And could that actually lead to an unwelcome strengthening of the euro if the euro really did become a challenger for the US dollar? Could that not lead to some perturbations in the European economy?
It's a very good question, of course. First of all, let me say that the big difference between the euro and the dollar is not the currency. The euro is a credible currency. It inspires confidence. At times, it was considered inspiring too much confidence. As you know, when I was myself president of the ECB, there was some criticism that the euro was too strong, too credible, too full of creditworthiness. I don't buy that, of course, but it means that the currency is there and has fully succeeded. The difference between the US and Europe is that you have a US treasury in the US and you have not, until now, a European treasury, a euro area treasury. And that makes an immense difference in terms of depth and liquidity of the, I would say, tradable securities that are the currency weaponry, if I may. If you have the currency alone, you have nothing. You need, of course, some tradable securities. So I'm not surprised at all that the emergence, a modest emergence in comparison with the US, of course, of a safe asset representing the full body of the euro area is welcomed by many, many investors in the world. I'm not surprised at all. And again, I would say, consider that this new generation EU is a very, very important move by all consideration. I said that publicly. I think it's a very important, one of these very important moments in the life of Europe. But of course, it is not overnight that we will have a European treasuries, a euro area treasuries like the US treasury. And so the difference between the US and the euro in terms of depth, liquidity of markets will remain, and maybe it's good that it's not a dramatic, overnight change for all the reasons you have mentioned and I had mentioned myself.
Let's talk about central banks and risks. Another interesting part of our poll amongst the central banks and the sovereign institutions, but something like 26% of the central banks plan to expand their corporate bond holdings, and 21% say they're going to increase their equity holdings. Does this not lead to a conflict of interest when central banks become so much involved in markets where they are themselves helping to set the valuations? Some would say that the operations of the central banks, look at, say, the Bank of Japan in ETFs, actually distort the market for equities. Is there not a danger that central banks are doing too much and getting into markets where they are inevitably going to lead to some conflicts?
If the central banks, at least some central banks in the world, particularly have to say in the advanced economies, have embarked massively on purchasing tradable securities, it is not to, I would say, optimize their investment. It is certainly not to take risks that would be undue. It is because it was called for by the overall monetary policy. We had a very abnormal situation in the advanced economy since the last great financial crisis, with growth miserable, productivity progress miserable, equilibrium interest rates very low, abnormally low, inflation abnormally low, and so forth. And that explains why, to prevent the risk of materialization of deflation, they all embarked in those kind of action. If the market believe that they will continue eternally to have this kind of action and to utilize these kinds of monetary policy tools, they are plain wrong. And I don't trust for 1 second that there is a conflict of interest and that the monetary policy of the central banks of these countries or these economies will be hampered because they would not want to augment interest rates in order for their own portfolio not to be hampered. So I don't trust that for 1 second. And it seems to me that we have full explanations for what has been done in the past. And I hope very much that it will not go forever, because it's not sustainable in any case in the long run. So I expect that the situation will improve considerably. I am quite happy with the idea that now inflation is back, because during 10 years, 12 years, we were fighting to get inflation back. So in a way, it's a victory. Of course, it has to be very, very carefully followed by and monitored by the central banks. They have a responsibility, which is price stability in the medium and long run. And I'm very, very happy that all major central banks in the world maintain this idea of price stability in the long run remains of the essence for central bank, with the same figures, 2%.
On that line of 2%, which the ECB has just enshrined as its central figure, should not the central banks, particularly in Europe, but also Madame Lagarde, the successor of Mario Draghi, who was your successor, should central banks now not be calling actively for higher wage rises? Because that would be one way of pushing up the inflation rate to 2% and maybe a little bit more.
Well, I would agree with that. I said that publicly several times. And I am in agreement with Gordon Brown in this respect. The loss of, I would say, bargaining power of labor is part of the difficulty the central banks had, and not only the central banks, but all advanced economy had during the last 12 years, say, or to oversimplify. Clearly, we have something which is very abnormal there. So we have a lot of causes for the very low inflation that we have observed and the danger of materialization of a deflationary risk. But one of the causes is certainly the loss of bargaining power of labor. And I call myself, and I'm happy to see that now there is recognition. In the US, for instance, it's very clear that you cannot eternally have a very flat remuneration of workers and employees. It becomes a political problem, and it was, since the very beginning, in my opinion, a political problem. Of course, it's not the major cause, but it's one of the reasons why we had to put on the central banks an additional burden. They should not be the only game in town. They were very much the only game in town over the last 10 years.
Let's talk for a moment about gold. We also looked at that. An astonishing 45% of the pension funds we looked at now invest in gold. You've just been speaking about a revival of inflation, which is partly welcome. But what does this interest in gold by ordinary investors across the spectrum tell us about the state of confidence in the world economy?
Well, first of all, confidence in the currencies. I would say that I don't take it that there is a real problem which would be due to a burst of inflation in the global economy or in the advanced economy, to take the example of the advanced economy. I think really very, very clearly that the central banks are there. They cannot lose all their credibility in letting inflation to gallop. And I am absolutely sure whatever is said by the central banks, including forward guidance that they will not increase rates for a very long period of time, if there is a real danger of inflation, they will, of course, change their monetary policy, because it is essential, it is of the essence for their own credibility and for the prosperity of their economy. So again, I don't interpret this gold increase of investment as motion of I would say, absence of confidence in the present currencies. I take it that it's part of the overall diversification. I will interpret that a little bit like the Bitcoins and I would say cryptocurrencies investment, which after all are also this very kind of speculative investment that in a portfolio that is managed at a global level, maybe you consider it is not correlated with your other investments, so why not a little bit of this, a little bit of that? But I have no interpretation which goes over that.
And of course, the big central banks of the European countries, France, Germany, Italy, are among the largest holders of gold. I remember your predecessor as the Director du Trésor, René Lahr, who used to say that gold lives on down in the vaults, unused, but not unloved. So there is a role of gold, would you say, still in the world monetary system?
At least as some kind of strategic asset. And you remember in the United States, the gold is in the hands of the Treasury, not in the hands of the central bank, in the vault at Fort Knox. And it seems to me that it is considered, as well as in the other countries of the world, as a strategic asset. Of course, in case there is a totally dramatic events. But I don't see any monetary role for the gold today, at the moment we are speaking.
I want to ask you something about Gordon Brown right at the end, but before that, just one question on getting the right balance between fiscal and monetary policy. Rather echoing what you said just now, 74% of the central banks in our survey said that they thought monetary policy was having an excessive influence on financial markets and pricing, but only 42% felt that it needed to be actively changed. What do you think should be the right balance between fiscal and monetary policy in the future, bearing in mind that in Europe, there's still very accommodative fiscal policies, unlike the position after 2010. Do you think that the fiscal authorities have now learnt the lesson from history that you need to keep up the fiscal accommodation quite some time after the immediate recession has ended?
Well, I'm not sure I fully buy that. We, of course, had a very, very absolute necessity of active fiscal policies after the previous crisis, and we had an absolute necessity of very active fiscal policy in the time of the COVID-19, of course. It was done very well, in my opinion, by all countries on both sides of the Atlantic. But again, we should not consider that it has to go on forever. If it went on forever, we would be in a totally unsustainable position. So I think that you have to be, I would say, balanced in all the call that you are asking the parliaments and governments to do when you are a central bank. At certain moment, you have to call for discipline, for budget discipline, because it is required by the circumstances. In Europe, for instance, at a certain moment, had some countries followed the budget discipline of the Stability and Growth Pact, we would have avoided the dramatic sovereign risk crisis, and we paid a very high price for that. So at other moment, of course, you have to call countries to be as active as possible in order not to overburden the central bank. In the present moment, I would say I hope very much that we will get through the COVID-19. The health situation is commanding everything, and we have to adapt to the health situation permanently. But what I would hope very much is that we will not continue forever, both, I would say, the extraordinary expansion of fiscal policies. In the US, do you know that it was in year 20, minus 15% of the GDP of the US. And again, in 21, we are expecting minus 15 or 16% of the GDP of the US. So it's totally gigantic. In Europe, it's something like 9%. But in both cases, it is gigantic. So it cannot go forever. That's clear. And as far as monetary policy accommodation by central bank, it cannot go forever either. So we have to get all that fixed and get back. And again, I would say the health situation is commanding everything in the present.
It's like the old adage of the saints, isn't it? Make me holy, but not yet. 10 years ago was the last time that the European Central Bank raised interest rates, in July 2011, when you were president. Looking back at that, Jean-Claude, was that a mistake?
I don't think so. At the time, we had totally forgotten. We had an inflation which was very close to 3%. It would have been a blessing, of course, during the years afterwards. And there was some indication that some kind of deviation could be observed in some markets. So it was a slight sign that if monetary stability was of the essence, which is always what has been recognized. It was part of the success of the euro. Had the euro, you remember at the setting up of the euro, a lot of observers were thinking that it would be a total mess, that it was unthinkable that this currency would be a credible currency. And we made it a credible currency. All that being said, of course, as you know, at the same time, we did what you said in the interest rates. I was intervening massively with a totally, I would say, extraordinary monetary policy tool to purchase currencies of Greece, Ireland, Portugal, Spain, and Italy. It was the first time a central bank was massively intervening in a totally non-standard policy to counter abnormal situation in terms of monetary policy transmission in the euro area. So I was, on the one hand, extremely bold and criticized for being extremely bold by many, and on the other hand, very attached to demonstrate that the currency was not at stake and that its credibility was there.
No, I can see that. Yes, it was a quid pro quo. I remember Mr. Berlusconi and you having one or two arguments about the conditions. Now, just the final question, is this role of the central banks in the future? Gordon Brown, we just mentioned, the former British Prime Minister and Chancellor of the Exchequer, has just written an important new book under which he's talking about 7 ways of repairing the flaws in the world economy. He's talking about a lot of wide-ranging themes here, ranging from the pandemic through to education and nuclear proliferation. But one of the issues that he puts forward is the need to have a more joined-up approach between the central banks and the fiscal authorities, and also says that the central banks should not hesitate to step in for the private sector from time to time if that is needed, as it was certainly after the 2008 crash. And he echoes approvingly some of the things that you have said in the past, Jean-Claude. If this is the new world we're getting into, you've been a central banker for a long time. What are the changes in the mentalities and the motivations and the mandates of the central banks that we need to bring about to take account of this very large transition?
Well, first of all, it seems to me that most central banks in the world are still very attached to their monetary stability, currency stability, which is very often in their own mandate, first. Second, they have now a responsibility in terms of financial stability. That's very clear. And it can be linked to the monetary stability, to the currency stability, because if you have financial instability, you are, I would say, calling either for a catastrophe in terms of the value of your currency, and it is something which would be very dramatic, or you are calling for hyperinflation. So in all cases, there is a very, very close link in this respect, and we have to understand fully that. Now, it's also clear, as we already said, that the central banks cannot be the only game in town. So they have to do whatever is necessary to fulfill their mandate. And they did it very well, obviously, all over the last period of time, and certainly since the setting up of the euro. But they cannot solve all problems. And there are clearly ways of communicating with governments, with parliaments, depending on the circumstances. There are ways of communicating with the private sector, and we should not ignore that the private sector is not commanding the central bank, but the central banks are influencing the private sector. And also the social partners should be considered also a major partner, seen from the perspective of monetary stability and from the perspective of the central bank. So I see the central banks doing their job on the one hand, with all the weaponry they have acquired, and on the other hand, being very eloquent in communicating with all the other partners. If they are not sufficiently eloquent, they will be the only game in town, and you can count on the other partners not to take account at all their own responsibilities. So it's a very important new, in my opinion, task for the central banks.
So communication is extremely important. The final question would be, certainly, many people thought after you left in 2011, there wouldn't be another French president of the ECB for quite a long time. They were wrong. How do you think Madame Lagarde is shaping up as the ECB president in a very difficult position?
I think that she did a very good job, obviously. And it seems to me that it is recognized by all observers. She took very bold decisions when it was necessary. And of course, we will judge a mandate over the long run, the 8 years. But at the moment I'm speaking, I consider she did a very good job.
Well, thank you very much indeed, Jean-Claude. You've taken us through a journey through a great number of the parts of the central bank's operations in the light of the survey that we've done. I'm very grateful that you've also cast a light into the future. But thank you very much indeed for talking to us today, Jean-Claude, and look forward to the next time. And I'm going to hand you back now to our colleagues who are going to take you through the rest of the survey and the rest of the Global Public Investor 2021 report. So thank you for being with us, and please do stay tuned.
Thank you very much, David. And thanks also, of course, to Jean-Claude for those fascinating insights. As always, it tells us that we're living through extraordinary times when a doyen of central banking welcomes a spike in inflation. I wonder, though, when we look through the key findings, whether our panelists and those who took part in the survey will agree with him that the diversification trend is a short-term one. I think our findings will tell us that this is actually a longer-term secular shift as investors look to increase returns by effectively taking on more risk. But more of that to come in a moment. Hopefully that has whetted your appetite enough already to download the report. You can do that through the link at the bottom of your screen, omfif.org/GPI21. But if it's not enough, in a moment, Pierre Ortlieb, our head of policy analysis here at OMFIF, will walk you through some of the key findings. Just a quick word, Pierre and his fellow members of the policy and research team here at OMFIF have had their own form of lockdown over the last few months as they've researched the 850 central bank reserve managers, sovereign funds and global public pension funds in the report, and gone through the results and the findings of the survey of over 100 of those GPIs, which Pierre will now present to you. So Pierre, over to you.
Thank you, Clive. Good morning, good afternoon, or good evening, everyone, depending on where you're joining us from. I just wanted to take a few minutes to present some of the main findings from our survey and our research that constitute the GPI 2021. Thank you to all of our survey participants. There are over 100 of you this year. It's a growing sample every year, and we appreciate your input in our study. So I'll quickly run through some of these, some of the key points that came out of the questionnaire before beginning our panel, which will discuss some of these same themes. So let me move on to the first slide. Now, these first couple of slides will give us a sense of the impact that the pandemic and the lower for longer environment are having on reserves managers and sovereign investors more generally. So as you can see here, the third set of columns shows that diversification is increasingly being driven by a desire to preserve capital. So it's becoming increasingly difficult to merely keep things ticking over. If you go through to the next slide, what we see here is that one of the main channels through which the pandemic will shape sovereign investment over the coming years is the monetary policy channel. If you see the fourth set of columns, what that says is that the lower for longer environment is going to have a profound and protracted impact on reserves management, making it more difficult to preserve capital, making it more difficult to manage reserves in a way that is in line with the principal objectives of safety and liquidity. So can we move on to the next slide? And so, you know, that the other side of that coin of lower for longer, my colleague David, our chairman, was alluding to this finding earlier. There's also a growing sense of worry about the impact, the footprint that central banks have in financial markets. So as you can see, what we have here are two questions illustrated. The first two sets of columns on the left-hand side show that many of our respondents feel that monetary policy is having an excess influence on financial markets. So that's, that's kind of another way of framing the first two slides around lower for longer and preserving capital. Monetary policy is making things very difficult for reserves managers. But then the right-hand side of this two-chart figure shows that most of these respondents also feel that monetary policy should not be reconsidered to remove that influence. So the benefits of the low interest rate policy pursued by many of the world's central banks is the benefits outweigh the costs for the time being. And if we move on to the next slide, the way in which central banks are responding to this obviously is, so we were talking about how capital preservation is being is driving a diversification push. And we see that in the responses to this kind of central question of our survey, and in us, sovereign investors, how they're planning on modifying their asset allocation over the coming 2 years. And what you see here is our central bank responses to that question. And as we can see, the sort of move up the risk curve that has been spoken about for a number of years is slated to continue, with corporate bonds and equities set to benefit. There's also quite a split on government bonds. So you can see on the left-hand side of the chart that a number of institutions are planning on adding to their government bond holdings, whereas a similar share of institutions are planning on reducing their government bond holdings. And we asked a more specific question around government bonds that will help elucidate that balance and its implications for markets. So if we move on to the next slide, this is a question that asks more specifically about different subcategories of government bonds and which are in favor and which are falling out of favor. And as you can see, the sort of sovereign or quasi-sovereign bonds that are most in favor are supranational and emerging market sovereign bonds. So those that offer slightly higher yields, that allow capital to be preserved in an easier way. Those are the government bonds that are in favor, whereas those that are falling out of favor are, as you can see in the sixth line, developed market sovereign bonds. Those on net, sovereign investors plan to reduce their exposure to that asset class. Same with euro-denominated sovereign bonds, AAA rated sovereign bonds. So these. There's a split within the universe of government of sovereign bonds, and what that suggests to us is that even the most conservative reserves managers are trying to find creative ways of picking up an extra bit of yield to preserve capital within their pretty strictly defined investment universe. So if we move to the next slide. Another way in which this trend is manifesting itself is in green and sustainable assets. So green bonds, for example, offer a way to both pick up slightly higher yield and to integrate ESG to satisfy sustainability criteria. And as you can see on the left-hand side of this chart, green bonds are in huge demand among central banks, especially. So the share of sovereign investors that are planning to add to their green bond holdings is rising. Almost 60% of sovereign investors plan to increase or significantly increase their holdings of green bonds. Slightly lower figures for green or sustainable equities and other sustainable assets. So this is another way in which this kind of the twin trends of diversification and ESG are intertwining. And if we move to the next slide, this particular slide points to a different diversification trend. It highlights the degree of currency diversification that we can expect among central banks. So David and Jean-Claude Trichet we're discussing potential changes in the international reserve currency system just now, and these are kind of the data points that corroborate some of the suggestions floated in that conversation. So as you can see in the leftmost column, almost 30% of central banks plan concretely to add to their renminbi exposure over the next 1 to 2 years, whereas traditional reserve currencies such as the dollar and the euro are slated to fare much worse over that same period. And what's notable as well is if you compare it to the 2020 findings that we presented last year, it seems that there's a much higher volume of expected change in currency allocations. So that suggests to us that there might be that central banks might sense some volatility coming in the global economy and specifically in the reserve currency system. And so if we move to the next slide, please. Another way in which these trends are coming together, so you have desire to hold greater renminbi assets, a reach for yield, a desire to diversify. What you see here in this chart is that there's a lot of demand specifically for assets from the Asia-Pacific region. So obviously emerging market debt being one of those assets. So that demand is really stood out to us when we were going over these results. And so you see it here, almost 40% of central banks plan to add to their holdings of Asia-Pacific assets, whereas compared to, and that's more than twice as high as last year's figure, whereas the share of central banks planning to add to their holdings of North American assets, presumably US treasuries and the like, has declined. So if we move to the next slide, another trend that stood out in the report is the way in which central banks are intensifying their approach to ESG integration. So what this chart shows is the way in which sovereign investors' priorities, their institutional priorities, have changed over the past 10 years. So the blue column shows the present day ranking of a certain institutional priority. The darker blue column shows how this priority was ranked 5 years ago, and the gray column on the right shows how that priority was ranked 10 years ago. So what we see here is that climate change is growing in importance as an institutional priority. If you look at the leftmost trio of columns, there are almost 10% of central banks surveyed suggested that climate change was the joint most important institutional priority for their institution, and the share who ranked it as the least important priority has declined by more than 30 percentage points. So a growing sustainability is becoming increasingly important for central banks in different ways. And if you go through to the next slide, please. This is reflected here as well, where we kind of look in closer detail at the concrete ways in which central banks are approaching this question. The share who don't implement ESG has declined slightly year on year, as you can see in the top bars. ESG integration is rising as a preferred strategy, so that's the fourth set of bars from the top. Positive screening is also rising as a strategy. So these are a few of the different ways in which central banks are approaching the ESG question. And if you move on to the next slide, please. A final point that I'll leave you with before we start the discussion, and obviously these findings are examined in much greater detail in the report itself, which I encourage you to download and read. A final question that we pose in the report is, well, central bank reserves are growing. They've grown by $1.3 trillion over the end of 2019. They are slated, they're projected to continue growing, with a majority of central bank respondents to our survey saying that they would continue accumulating reserves. But then there's also this finding, which suggests that in the event of a severe currency shock, only just under 60% of central banks would be willing to use more than 30% of their foreign exchange reserves. So obviously signaling effects are important in averting currency shocks. However, it does beg the question of whether there are social costs to these sort of giant piles of reserves, whether they might be invested more productively, and that's why we're seeing the trend towards diversification that we spoke about earlier. If we move on to the next slide, we also look in some detail at the way in which asset owners use external asset managers and the way in which those relationships have changed as a result of the pandemic. So we have some interesting new findings there drawing on this survey-based data set. And so next slide, please. Finally, we also have some great contributions and interviews with a range of asset owners. I've highlighted two here, an interview with Judy Wade from Canada Pension Plan Investment Board, a great piece from the Bank of Korea on how their reserves management strategy during the COVID-19 shock differed from that during the Asian financial crisis. So a whole range of great content, both from the survey as well as our internal research and external contributions. So I invite you to download and read the report. There's a lot to unpack there. And with that, I will end my presentation and start the panel discussion with our 6 panelists. So I'll invite everyone to turn on their cameras. So I'm delighted to be joined today to discuss some of these themes by a range of great speakers. So we have Didier Borowski, who is the head of global views at Amundi, the asset manager. We have Juan Carlos Piantini, head of financial markets analysis at the Central Bank of Chile. We have Sandra Svaljak, deputy governor at the Croatian National Bank, who also very kindly allowed us to interview her on the Croatian National Bank's approach to reserves management and their take on the global financial safety net as part of the publication. We have Daniela Klingebiel, who is manager of the Reserves Advisory and Management Partnership at the World Bank Treasury, Haryadi Ramalan, head of monetary management at Bank Indonesia, and finally, Christine Mikolayuk, who is the EMEA Chief Operating Officer for Global Client Management at Bank of New York Mellon, one of our partners. So with that, I will start the discussion by inviting the panelists to give about 5 to 8 minutes of opening remarks. So perhaps we can...
My camera is blocked.
Oh, there we go.
Okay, thanks.
Okay, there we go. Great. So I'll invite Juan Carlos to start us off with his opening remarks, please.
Hello, everybody. Thank you very much for inviting me to this panel today. So I will share with you some of the recent developments that we have had in Chile related to international reserves management in the context of COVID-19. So some of the negative effects related to COVID-19 have been mitigated, as in many other parts of the world, with expansionary monetary policy. And in our case, this was complemented with the expansion of credit facilities, which have led us to double the size of the balance sheet of the Central Bank of Chile. Of course, these measures that we have taken are very well aligned with the Central Bank's mandate, which is inflation and financial stability. And I would say that so far we have been successful with inflation around our target and with credit flowing to the economy. And in relation to our international reserves, what happened is that given the size of the shock that we were facing, our risk scenario deteriorated significantly. And to put it in a nutshell, we realized that the size of the reserves was impaired with the potential negative outcomes coming from our balance of payments. So as a result, we decided to strengthen our international position in order to complement our liquidity buffers in foreign currency, which have been key to ensuring the proper functioning of financial markets and to maintaining the confidence of economic agents. So the question is, what did we do to increase liquidity buffers? So let me highlight three main points. First, in May 2020, we accessed the IMF Flexible Credit Line, the FCL, by an amount of $24 billion, which represents 10 times our quota at the IMF. So as you can see, the amount is very significant for us. If you want to put it in another perspective, the amount was close to 60% of our reserves at that time. It is worth mentioning that the FCL is going to be active for us till May 2022, that is 2 years in total, and it has not been used, and everything seems to indicate that we will not use it at all. So we ask for this line more for precautionary purposes. And also, in January this year, we implemented a program that aims to purchase $12 billion of international reserves. And here the objective is to raise the ratio of reserves to GDP from 14 to something close to 18% of GDP. We are going to accomplish this in 15 months. That means that we purchase from the market 40 million per day. It is important to notice that the end of the purchase program will coincide with the end of the FCL. So basically, this is our exit strategy from the FCL. And third, also it's worth mentioning that we requested and got access to the Fed repo. So far, we have not used the facility, and as you know, the repo will be available until September, as I understand, in case there is no additional extension. But in this general context, let me share with you what have we been doing in terms of our portfolios. So first of all, I will touch on portfolio diversification, and the truth is that recently we have moved a little bit in the opposite direction. But let me explain it to you. Before the pandemic, we had a portfolio that was made up of 50% in US dollars and the remaining 50% in other currencies, which I think was a good level of diversification. So we had exposure to currencies such as the euro, the British pound, the Kiwi, Aussie, and Canadian dollar, among others. But also the Chinese renminbi and the Korean won were present in our mix. This is a reflection of the fact that we like the benefits of risk diversification. However, given the greater risk that we were facing, and consistent with the conclusion that we needed a larger reserve buffer, we decided to dollarize the portfolio and bring the USD share to 77%. So now, as our liquidity buffer grows with the reserve purchases that I alluded before, the challenge is to re-diversify the portfolio and probably move away from the dollar a bit more. But I think that discussion is going to happen early next year once the purchase program comes to an end. Interesting enough is the fact that the renminbi is currently the second currency with the largest presence in our portfolio, representing 8% of the total. This is due to the spread offered by Chinese government bonds, and also for the good properties in terms of diversification, and because the renminbi is a relatively stable currency. And in connection with this, let me spend a few words in relation to negative rates and how we are dealing with the euro in particular. So when the euro was launched, we were one of the first central banks, outside the orbit of the ECB, in being more aggressive towards the euro. In fact, at some point in time, 40% of our portfolio was invested in euros. But since then, the share of the euro has been declining in our portfolio due to two main reasons. First one, the European debt crisis, and second, the negative interest rates. So as a result of that, and in conjunction with other optimization considerations coming from our models, currently we keep only 5% of euros in our portfolio and only in instruments indexed to inflation. Why? Because those instruments still offer some benefits from a risk diversification perspective. I think this is remarkable because despite the international role of the euro, which is very relevant, of course, in our experience, we have been decreasing the exposure to this currency in a very aggressive manner. And let me underscore the fact that low-yielding portfolios is a problem for some central banks because we tend to have a negative carry in our balance sheet. For sure, our main objective is capital preservation and liquidity, not achieving returns goals. But it's also true that in some degree we have to factor in the fact that we pay a premium for holding reserves, which is the price of the insurance at the end of the day, right? So we want that price to be relatively low. And regarding the new credo that Marcus alluded to at the beginning of the meeting, a few words on ESG integration in central bank reserves.
Juan Carlos, if I'm sorry for interrupting you, but I think I'd actually like to get to the ESG question a little bit later, if you don't mind.
Sure.
So at this stage, I'm sorry for interrupting you, but I'd quite like to get to the ESG question a little bit later. So just in the interest of time, I'd like to invite Sandra Svaljak from the Croatian National Bank to share thoughts on similar themes that you've just spoken about. And I'd like to remind the audience that you can ask questions through the Slido function on the OMFIF Live webpage. So if there are any questions, we'll try to get to some of them later. So thank you, Juan Carlos, and Sandra, over to you.
Thank you very much. I would like to say hello to you and to the audience and express my gratitude for inviting me to such a prestigious panel. And I would also like to congratulate you for publishing such an impressive volume as a global public investor for 2021. I wanted to share a few words with you about, first of all, ensuring adequate returns in Croatian case, given the role and the structure of foreign exchange reserves in Croatia. I would also be ready to talk a little bit about the ESG and other issues related to green and sustainability. Maybe also to mention the role of external managers. However, maybe you would also find it interesting to hear a little bit more about the operational challenges that we have faced in Croatia, given not only the COVID pandemic, but also two devastating earthquakes in Croatia. So the challenges of managing the FX reserves in Croatia last year were really extraordinary. However, let me go back to the issue of adequate returns. Of course, as in many other countries, in Croatia, we have struggled with ensuring adequate returns given the dominance of euro in our reserves portfolio. You may ask ourselves why do we keep that high proportion of the euro in our reserves portfolio, but that is simply the result not only of the macroeconomic fundamentals, but also the result of the role of FX reserves, and that is to maintain the stability of our currency against the euro. You know that we are currently participating in ERM2 and preparing for Eurozone, but we are still outside of the Eurozone with the kuna as our own currency. So the share of euro in our FX reserves is currently 85%, which is very high. The rest pertains to the US dollar, some 13%, and the very small percentage to the SDR. But generally, 85% of euro in our FX reserves is relatively high, given the possibility to earn any positive returns on euro. However, we do not have in mind to change our current structure of FX reserves, and we would stick to being a very conservative investor. We don't, in spite of the fact that some assets are becoming more and more attractive, we don't intend to change our exposure to credit or to currency risks. However, given that preserving or achieving any positive return out of our reserve management, we have decided to make some tactical and strategic adjustments in our FX reserve management process. And basically what we have done still in 2011, we have decided to extend the maturity profile of the part of our investments. And that is basically something that have ensured positive returns of our reserves in last year. So basically, we have not engaged in direct diversification, but we have rather extended the maturity profile of FX assets that were already the part of our reserves. And actually in 2020, the return on our euro portfolio was around 0.20, 0.22, whereas the return on our US dollar portfolio was as high as 1.54%. So we have, with some small adjustment of our, but for us important adjustment of our FX management strategy, we have succeeded in achieving some positive return, but basically we will stick to preserving the liquidity and security of our FX reserves. What we have also done last year, and we deem it's a very important move, we have switched to the ECB accounting guidelines, and we have also made some changes in the Act on Croatian National Bank according to this move to the ECB accounting guidelines. That basically will allow us some more flexibility regarding our foreign reserve management. However, that does not mean that we will increase our risk tolerance in the future, since we know how important that is to preserve the high liquidity and high security of our reserves. And basically, we have witnessed, we got assured last year how important it is to have sufficiently high FX reserves and abundance of liquidity in our FX reserves, because we had to intervene quite massively on FX markets. Our FX interventions last year were as high as 5.5% of the GDP, which makes some 15% of our FX reserves, and thereby, in spite of the very disrupted liquidity on the markets, we were able to stabilize kuna, and we have been able to use our FX reserves in a very appropriate way. I'm afraid that I'm running out of the time, so maybe I will
Thank you.
leave some time more for some other.
Excellent self-awareness. Thank you. That was very interesting. To carry on the opening remarks, I'd like to turn to Didier Borowski from Amundi for his thoughts. Thank you, Didier. Over to you.
Yes. Good afternoon, everyone. So I'd like to say a few words on the global macro-financial landscape that we are seeing and the regime shifts that we expect, and the implication on portfolios, investors' portfolios in this new regime. First of all, I think we all understand that this shock is unique. This was the deepest recession, but with no financial crisis, thanks to very accommodative monetary and fiscal policies. There is a consensus these days to say that it's premature to remove supportive policies, both on the fiscal side and on the monetary side. And it's all the more true given the recent news flow regarding the pandemic. So this crisis, this health crisis, has not ended, in particular in emerging markets. And we know, and that's very important, is that from history, that pandemics can lead very deep scars on the economy. So we do believe that, in fact, fragilities have increased in this crisis, vulnerabilities have increased for many countries, and that it paves the way for a much more volatile macro-financial environment in the coming years. There are many unanswered questions regarding what economic policies should do in this environment. Basically, there is no clear-cut answer regarding when central banks and governments should stop supporting their economies. But as I said, there is this consensus that it's too soon to remove the level of accommodation. What we say is that in this new environment, investors seem to expect, in fact, an environment where both where growth would stay strong with more inflationary pressure, but at some point it's a kind of Goldilocks scenario that investors seem to expect. What we say is that part of the inflationary pressure that we are seeing these days are probably more persistent than what investors believe. And beyond the temporary factors that generate some inflation in the short run, we expect some persistent inflationary pressure to last. In particular, we believe that this crisis may lead to social tensions, to more bargaining power for workers, in particular in countries where the share of the labor in the added value has declined over time. So we have to monitor very closely what's going on in the United States. We know that value chains have been severely hit in this crisis, and we do not believe that there is a rapid normalization in the value chain. So as a result, part of the inflationary pressure that we are seeing are likely to persist over time. And that's a difficult macro-financial environment for central banks. Until now, central banks and governments have worked hand in hand to maintain macro-financial stability, and it was possible because inflation was under control. But at some point, you may have a conflict of objective if you have more persistent inflation, and if GDP growth comes back to potential, and potential growth is probably will remain under pressure due to demographic factors, due to the fact that productivity gains are under pressure. So at the end of the day, we could end this cycle with slower growth and higher inflation that would put, in fact, central banks in difficulty with a conflict of objectives. And at the end of the day, this stagflationary environment, even if we are not back to the 70s, this stagflationary environment may generate more volatility in the financial system. You have also the articulation between central banks and governments, that monetary policies and fiscal policies that has become more complex. To some extent, central banks are trapped in their QE policies in most advanced economies, it would be very difficult, in fact, to normalize monetary policy in this environment. And that's why we believe that we may have some macroeconomic volatility. And the important point for investors is that this environment, where you should expect bumpier business cycles with probably higher inflation, is an environment that is consistent with higher volatility on financial markets. And an important point is that for diversified portfolios, when you look now as the past decades, investors, we see at least 4 consequences for investors. Investors should rethink first the traditional balanced portfolio approach with 60-40, because basically bonds cannot expected return in the coming decade cannot be the same as over the past decades. A balanced portfolio, for a balanced portfolio, the expected performance contribution for the fixed income component is not possible to replicate over time. And that's true on the fixed income side for obvious reasons, because interest rates are very low by historical standards, but that's also true to some extent in the equity space, where equities have returned in excess of what was justified by earnings. And even in the equity space, we should expect lower returns from the equity share of any investor portfolio. So that's a big change looking ahead. And at the end of and in addition to that, we see also an evolution in the dynamic of correlations between bond and equities. We do believe that, in fact, the correlation has turned positive from a structural standpoint, and that you may have at the same time rising real interest rates and higher equities. So that's something that is a structural change, and it's going to be much more complex in terms of portfolio construction for investors to diversify their portfolios in this environment. We believe that investors should increase, in fact, their exposure to equities and build diversified portfolios beyond, in fact, the traditional benchmark allocation, and should include, looking ahead, real and alternative assets, higher yielding assets, including, for instance, emerging bonds. On bonds, go beyond benchmark, a very flexible approach. Investors should move away from the static and benchmark constrained strategies and look for value in unconstrained strategies. And they should also focus on all the income sources available across the fixed income space. And core bonds will continue to play a key role in asset allocation, in particular for liquidity reasons. So the third point that I want to say is that in this world of lower returns, equities are a structural must-have. But not all equities. We believe that we have to be very careful in terms of diversification, favoring dividend yielding stocks, those who are exposed to real assets, and we should for sure be very cautious on interest rate sensitive stocks. In our central scenario, we expect in the coming years, in fact, higher real interest rates, higher nominal and real interest rates. And it's something that is not fully priced in by markets at this stage.
Didier, I'm just going to stop you here in the interest of time. I think you've sketched out some of the main planks that we're seeing, and I'm noticing some themes emerging in this discussion already around higher inflation, higher market volatility. That we'll come to in the discussion in a moment. I'd just like to invite Haryadi Ramalan from Bank Indonesia to share his views on these topics as well. As our penultimate panelist, and then we'll move on after that. Thank you.
Thank you, my friend. Good afternoon, ladies and gentlemen. I'm pleased to join today's OMFIF meeting for the global public investor, which focus on the role of state central bank and the foreign reserve and how central bank can best use their balance sheet to help economies recover from the COVID pandemic. As your information, I've been working as the head of Reserve Management Department, and now since February, I already moved to Monetary Management Department. There are three things that I would like to share. The first one, how Bank Indonesia manage the international reserve to support the exchange rate stability. As you know, the foreign reserve is also deployed to support exchange rate stability to maintain sustainable economic recovery. It is used to have export intervention when needed in line with market mechanism. Besides FX export intervention, BI also use other instruments to support exchange rate stability, such as domestic non-delivery forward and government bond purchases in the secondary market. As BI's total asset increasing, especially due to the bond purchase program, the proportion of forex reserve to total asset has been decreasing from approximately 76% at the end of 2019 to approximately now 62% in the mid of this year. Still, the forex reserve has increased around 13% from 121 billion US dollar in March 2020 to now around 137 billion in this mid-year. To maintain the adequate foreign reserve while optimizing it, we create three portfolio tranches, such as the liquidity tranches portfolio, liquidity buffer portfolio, and long-term investment portfolio. The FX reserve is mainly allocated to US dollar currency and spread product. We're also using the strategic asset allocation, which reflected the risk appetite of the board of governor in calculating the risk-return balance as a part by the strategy and the reserve management part. And the second one, I would like to share about the accommodative monetary policy, that the accommodative monetary policy at the moment using by central bank to support the economic recovery. Besides, we are also funding government budget deficit. Bank Indonesia also maintain the accommodative monetary policy to support the economic recovery. BI has reduced the policy rate 150 basis points to 3.5%. It's the lowest ever in the history of Bank Indonesia. Due to the increasing fiscal stimulus that is supported by BI bond purchase, liquidity in the banking system has risen by almost twofold from its position in the early 2020. 79% of the liquidity absorption in the monetary operation outstanding are in the overnight to 1 week tenor. To maintain the adequate liquidity, BI also provide daily auction for term repo and the FX swap transaction in addition to the lending facility. Nevertheless, the usage of liquidity injection monetary operation has been decreasing due to ample liquidity in the banking system. And lastly, how is the important synergy between central bank, as Jean-Claude Trichet also mentioned, the role, important role from central bank and the government to support the economic recovery. As you know, we have 4 policy in the transformation. The first one is strengthening the agenda in policy transformation, organizational transformation, human resource transformation, and digital transformation. By the pandemic triggering the extraordinary measure, both from monetary and fiscal authority, that are not implemented during the normal condition. To support the economic recovery, Indonesia government has increased its budget deficit limit to above 3% while still maintaining prudent fiscal policy. To accelerate the national economic recovery, central bank put more emphasis on strengthening the synergy of monetary expansion with acceleration of government fiscal stimulus. In this case, Bank Indonesia is committed to funding the budget deficit through the purchase of IDR government bond from the primary market in the measurable and the proper manner, both through auction by market mechanism and private placement. Here, BI act as a standby buyer. Furthermore, BI also share the burden with the government. The burden sharing scheme is resumed in this year, while the bond purchase in the primary market still continue. As financial market condition is improving along with the gradual economic recovery since the beginning of this year, GPI role as a standby buyer in the government bond primary market has been decreasing. I think these three role of us is very important to know to our colleague that the COVID pandemic situation has creating a challenging environment situation and create some innovation in the central bank policy. Thank you.
Thank you. That was great. Just for a final set of opening remarks, I'll turn over to Daniela Klingenbiel from the World Bank Treasury for a brief set of slides, I believe. Daniela, over to you.
Thank you. Good morning, good afternoon, or good evening. Thanks for the kind invitation. I'm delighted to be with you today. Congratulations to OMFIF on publishing this important report. As Pierre mentioned, I'm the manager of World Bank's Treasury Reserve Advisory Management Partnership Program. It's also short for RAM. RAM provides asset management, advisory, and training services to public asset managers. It was established in the early 2000s and now has 78 members, including 60 central banks. If we could kindly move to the next slide. To support its activities in the central banking era, RAM has undertaken global survey on all aspects of reserve management on a biannual basis. Our most recent survey closed earlier this year, and as you can see from the slide, we had respondents. We had 119 respondents, including central banks from all income categories, geographies, and size of reserves. These surveys allows us to investigate systematically how reserve portfolios and central bank reserve management practices importantly involved during COVID. And let me now review three important areas: the currency and asset composition of reserve portfolios, as well as the minimum credit rating as a sign of a change in risk tolerance. Where we do note significant differences from the previous surveys, I will say so. We expect to publish the full report in the fall. Let me just take the punchline away. It's in terms of punchline, the findings, as you will see, are really very much in line with what we heard from Pierre's opening remarks, as well as what we heard from the panelists. If we move to the third slide now. The graph shows the distribution range of the currency composition of all respondents' foreign exchange holdings. And not surprisingly, we see that the USD still dominates across all central banks, with a median of 72% for the proportion of assets invested in USD securities. The euro was the second largest currency exposure for central bank. It is important to note that compared to our survey 2 years ago, the average allocation to major currencies such as the dollar, euro, British pound, and Japanese yen decreased, while the average allocation to CNY increased significantly. On average, survey respondents allocate now 2% to CNY. If we move to the next slide, please. Now, let us turn to the current asset composition of reserve portfolios globally. And this slide shows the distribution of the allocation across asset classes for respondent. As you can glean from the slide, reserves continue to be concentrated in traditional asset classes such as sovereign bonds, supranational agency products, deposit, and money market funds. Highlighting the fact, and as reiterated by our panelists, central banks continue to maintain a conservative approach to investing their reserves in line with their objective of safety and liquidity. At the same time, central banks do continue to expand into non-traditional asset classes such as mortgage-backed securities and corporate bonds, and some have created exposure to equity. Nonetheless, it's also, as you can see here,
the allocation to non-traditional asset classes still constitutes a small portion of their reserve. If we kindly move to the next slide. Another indicator of central banks' risk tolerance is how far down the credit curve institutions are willing to go. And this slide shows the minimum credit rating across the set of eligible assets from sovereign bonds to corporate bonds and deposits. Again, most institutions continue to maintain a relatively conservative stance. 2/3 of the institutions are not investing in borrowers with lower than a single A rating. For example, for the sovereign bond space. In this aspect, our survey results are largely in line with those of a couple of years ago, but we do find one important exception. Central banks allowed to invest in corporate bonds, which is roughly 45% of respondents, increased the minimum rating in the corporate bond space slightly. And let me kindly move to the last slide. Now, with this background, let me summarize what we can learn from the survey and complement these findings with anecdotal evidence that we collect from our engagements with our members and make 5 concluding points. First, for central banks and for everyone else for the matter, COVID was truly a black swan event that tested central banks' reserve and risk management practices and resilience. The restrictions on economic activities and travel put in place by governments to save lives have carried significant economic costs and have resulted in significant asset volatility. It has affected emerging market central banks particularly, as many of them experienced initial capital outflows, and many of them were affected by almost a free flow in commodity prices and shutdown of tourism, important sources of income for a significant portion of these economies. Obviously, there were also concerns about reductions in remittances due to the global economic crisis. Now, second, if we look at their reserve management activity with government bond yields in major economies still at historically low level, comparing the results from our 2021 survey with those of our previous survey, we find that central banks have continued, importantly, to diversify their strategic asset allocation. Institutions have increased the number of eligible currency and the scope of eligible asset classes. Most notably, there was a 15% increase in the number of central banks that consider CNY to be an eligible currency. At this point, 2/3 of respondent central banks can invest in CNY. On eligible asset classes, inflation-linked bonds saw the largest increase in eligibility. They're now an eligible asset class for 61 of respondents, up from 45. MBS and corporate bonds also recorded increases in eligibility. Now, third, if we look in terms of actual currency composition, we find that central banks have decreased their average allocation to the dollar and other major currencies and increased, on average, the average allocation to CNY. Fourth, with respect to central banks' composition of assets, we observe that central banks are further diversifying the fixed income portion of their portfolios. Institutions decrease the average allocation to short duration products, such as bank deposit and money market instruments, while the allocation to most other asset classes, including government bonds, mortgage-backed securities, and corporates, increased. And the final point, central banks reduced their portfolio duration over the last 2 years, particularly we find in their investment tranche. And they did that by increasing their allocation to short duration bond. Now, if you think about it, it's not too surprising finding, given that at current levels of yields and the shape of the yield curve, duration risk does not appear to be well compensated. Thank you for allowing me to share.
Great. Yeah, it's reassuring, I'm sure, for both of us to hear that our findings in many ways corroborate each other. With the end of Daniela's presentation, I'd like to turn over to Christine from Bank of New York Mellon for her remarks as a first respondent and to sort of launch us into the discussion component of this launch. So Christine, over to you. Thank you for joining us.
Thank you very much, Pierre, and thank you for the introduction. And Clive, John, thank you for bringing together this great panel. And BNY Mellon is very happy to be supporting the GPI report again this year and to be participating here today. So thanks very much for that. Public institutions and investors played such an important role in stepping in and really stepping up to respond to COVID. But COVID's really become this marker in time. I think Didier alluded to this, a real sort of global moment, and we are here, talking today about a post-COVID world, and it's become this moment in which, yes, we're having to confront a number of market evolutions and changes, like the lower for longer environment and the exceptional growth of private markets, and we'll see how long that continues. But there are also many other trends going on. We mentioned some of them. ESG is a systematic imperative, and also the immediacy of the public's demands and needing to be responsive as an institution to the public. And I think the GPI report also highlighted the extent to which national and international geopolitical events are still very much top of mind, and that came out as number one frequently. But number three was often technological developments. So as central banks, you're looking at digital currencies, but even very immediately, we've all been propelled into the future of work, and institutions have had to think about how to accommodate and working from home. So taking all of this together, our view is that institutions feel that you're at an inflection point as all of this comes together. And we hear the phrase "build back better." Not all institutions have to build back their operations per se, although Sandra, you alluded to some of the difficulties that you faced. But there's a real opportunity here to look at institutions end to end and think about how can they really be resilient and nimble as you balance all of these objectives: safekeeping, currency management, growth, liquidity. And that means making a lot of big decisions, not just about your investments, but about the operating models that support them. And as a central orchestrator in the financial system, BNY Mellon sees its role as helping with those decisions and helping to implement them. And we think about them in three ways, which I suspect will resonate with the panel. The first is supporting the changes that come with new investment strategies. So you're entering new markets, new currencies, new asset classes, or even diversifying within fixed income that remains core. And there are basics like account openings, settlement practices, tax issues that come with that. And then we really think about, end to end, how operating models have to evolve to meet your objectives. Integrating ESG, that doesn't just mean making sure you're, excluding certain instruments or exercising authority and activism on the ESG front. It can also mean incorporating ESG into your securities lending practices. And that has certainly complexified the landscape there, as you need to recall a security to be able to vote, but you've lent it out. And then, finally, supporting all of this, there are some fundamental foundational considerations of how central banks are run: the resiliency of your systems, the security of your operations, and the technology and data that threads this all together. A small example of where we saw the key importance of systemic resilience was on the custody front, and not surprisingly. And among central banks, we saw a very sort of close focus and scrutiny of where assets were domiciled as the crisis took place. So, we maintain a network of sub-custodians around the world that sort of mobilize that scale, and we're able to respond to the risk oversight needs of central banks. But I think for central banks and other public investors, probably the biggest opportunity to seize, now and for the longer term, to really future-proof ourselves is data, and being able to put data together across, not just external sources, but internally, bring that to bear on the institution's purpose, get visibility to manage reserves better, make quicker and more efficient decisions and respond to shocks, provide your public with visibility. And that's, again, basics, like being able to incorporate different sources of data and having the correct taxonomies, ESG data. And there are also, plenty more sophisticated tools that can be brought together to integrate an institution seamlessly. So, as much as we're talking about a COVID moment, obviously journeys such as these and operational transformations it's a journey. It's systems are not simple to revamp. Mindsets internally are not easy to shift. So in addressing the panel, I'd be grateful if you could comment a little bit on how you're thinking about the operations of your institutions as we come to this inflection point, and how you're thinking about harnessing the opportunity of adjusting your operations for the future.
Thank you, Christine. So I think that's a great place to start this sort of discussion. And maybe Sandra, we can start with you. I mean, how have you dealt with the operational challenges, both that have already arisen from COVID and with the future operational challenges that will no doubt arise as these various diversification and sustainability trends accelerate? Maybe we can start there with some brief thoughts.
Yeah, thank you very, very much. I think it's very nice what we have just heard, and also comforting that we are all in the same position, and there are so many challenges around us, and COVID is just one of it. So I wanted to tell you a few words about our operational challenges. That in Croatia we had two heavy earthquakes last year, and this has really affected our work, because in the same time we were not only working in split shifts because of the COVID. We had to move from one building to another. We had to find the new working new offices, and move all our stuff there, all our equipment and everything. And in the same times, we were working on the largest FX interventions ever. So it was really very challenging times, and we have done everything well. We were very satisfied with it. However, it makes made us aware of everything that can happen, and everything can happen at the same moment. And maybe also just something to think about, work from home. That is something that we talk about now, and we have gotten accustomed to working from home. However, it is not the same if you work at the market operations department and some analytical department, because it's much less riskier to work from home if you work at some research department than if you work at the market operations department. In our case, we really have to be here and to work on FX interventions from here. So there are so many things to think about at the same time. And I just wanted to mention the ESG. That is something that is really close to my heart, and I really believe that each and every institution has to do its part. However, it's still a very uncharted territory, and we like to talk about it, but I'm not sure whether everyone has the same thing in its mind. And I am still although privately being fond of it, professionally, I think that we still have to be quite conservative. And I would like to put the focus on the fiscal policy part. So fiscal policy has to do quite a lot in that area. And when it comes to the central banks, I think that mostly we have to be focused on the risks around the climate change. We have to be aware how those risks affect our banks and their businesses. We have to know how those risks might affect price stability, growth prospects, the demand in the future and everything, and maybe incorporating ESG into the FX management is something, yes, we have to think about it, but maybe it's not the priority. And for us, just to mention that we are in the future, our setup will completely change with entering the Eurozone. And we will have to manage our non-monetary policy portfolio. And in that new setup, it will be the time to reflect on our investment strategy and how to incorporate ESG in our investment strategy. I think that at that moment, it would be more appropriate to think about it.
Thank you. Just on the operational side, I wonder if we can turn to Mr. Romelan from Bank Indonesia for his views on the operational challenges, both of the past and of the future. If you have any thoughts on it, we'd be very grateful if you could share them.
Thank you, Per. I think a very interesting topic to be discussed. We also have experience in the operational risk. That's why, as I mentioned before, we also make some new transformation in the digital technology and digital transformation. As you know, COVID-19 also makes some impact on how we working our office hours. So some people should be divided by two groups. One group back up for the core group, especially in the treasury room, and the two groups should be stay in another location that we call business resumption site. A bit secret place in the same city, and the group actually maintain what the portfolio backup. That's important thing for the central bank running what we call the portfolio backup position. So in this case, we can maintain if there is some operational risk, so we can handle by the business resumption side. And the other occasion, we also have some what we call alternate command center. Alternate command center is part of the board of governors meeting place, that also secrecy place, that if there is something that the office cannot be accessed because of, like our colleague Sandra, because of earthquake or maybe flooding, so we can use, let's say, the helicopter or something to go there to have the special meeting for the emergency board of governor meeting. That's part of the operational risk issue. What about the technology itself? We also maintain always new approach, new adopting, and the innovation of the technology. Now we are in the middle of process of the new generation in the Bank Indonesia central registry, and also what we call, and maybe there is some front office, middle office, back office system that's called FOMOBO, using like BlackRock system use. And we also make some of the real-time cross-settlement, the new generation system. So many part of the technological change should be answered by the central bank, and this is the challenge, I think. I hope.
Thank you. Thank you. That was a very helpful intervention. I just moving on quickly, I promised earlier that we would come back to the issue of ESG, and Sandra already touched on it. Juan Carlos, I very ruthlessly interrupted you earlier, but I think we would all love to hear more about how you at the Central Bank of Chile are integrating ESG in your reserves management processes. So if you could share your thoughts, I think we'd be very grateful.
Sure. Thank you, Pierre. So, of course, the world is moving towards more responsible investments in terms of ESG integration, and we want to be part of that trend. And one of the first conclusions is that the room we have to contribute is limited in reality. And this is due to the fact that the asset classes in which we can invest are very limited also, because we mainly invest in government bonds and supranational, so classic asset types for central banks. But anyway, we must make the effort, and currently we are exploring the best alternatives to make our contribution in this front. And in that context, green bonds appear to be a reasonable solution. And despite the fact that this market is growing very fast, there are still important challenges to solve. But currently, we're trying to find the best way to invest in green bonds in a responsible manner, and we think we are close to complete that process. And probably the outcome is that we are going to rely in external managers to at least to make the first step toward this, so we can benefit from transfer of knowledge, and in the meantime build our own capacities in order to for in a near future to do this by ourselves directly.
So the twin strategy of investing in green bonds and using external managers. Didier, I'd like to come to you. I mean, you were speaking to us earlier about regime changes, but I'm not sure that you honed in on sustainability too much. But maybe you can share your thoughts with us on the push towards sustainability and how that will impact macro and markets.
Yes, for sure. ESG will be a key component in asset allocation looking ahead. It's not only about the environment, it's also the S pillar and the social pillar that is likely to gain ground. And the ESG thematics has become, as Mr. Trichet said, a key concern for the ECB, and probably the ECB will encourage other central banks to move in this direction. So that's a new environment. The climate transition is crucial. It is crucial to finance investment projects in order to help the climate transition. Green bonds are expected to become a core component of any investor portfolio. The green bond market is growing fast and is maturing and becoming more diversified. So ESG is clearly a permanent trend that is likely to gain ground, that would require, in fact, much more discrimination among themes, sectors, and stock in the future. But clearly, central banks, we do expect that central banks will increasingly take into account this component in their asset allocation. So that's basically one of our mantra in Amundi, to say that we increasingly need, in fact, to work on these thematics. Thank you,
Didier. I like that you were referring to a newfound green warrior, Jean-Claude Trichet, who was speaking to us earlier. Well, in the interest of time, I think I'll leave it there. I'm sorry that the discussion was relatively short, but I think we managed to pack a lot of good content in there. So I'd like to thank you all again for participating. It was very engaging, and I was very grateful for all of your interventions. I'll leave it at that, and I'll encourage you a final time to download and read our 2021 report. And with that, I'll hand it over to my colleague Clive for some final remarks to wrap this up.
Thank you very much to Pierre, and thank you to all our panelists for taking part in a very, very lively discussion. Hopefully you can see me and the camera's working. We were having one or two issues earlier, but I will plow on regardless. As Pierre says, we barely touched the surface of the report, and if you haven't got the message already, do please take time to download it, omfif.org/GPI21. The phrase uncharted territory was used occasionally during that panel discussion. Certainly, I'm sure for many central bank reserve managers, that's how it feels at the moment. Hopefully, reports and research such as this and discussions such as this helps to take the conversation forward. We only touched on some areas. Christine, I think, during the panel mentioned digital assets. There is a section in the GPI report on what is stopping the GPIs from investing in digital assets right now. And that's something, again, you can see if you download the report. The report contains some chapters that you should look at too. One on reserve management, of course, on asset allocation and sustainability. We have a new chapter focusing on the increasing role of external managers, which we just heard about. And of course, they're at the forefront of helping GPIs with their diversification drive. Communication is also very important. And we have a chapter on how central banks are using social media to communicate with all stakeholders at a time when they're playing such a fundamental role, not only in supporting the economies now, but hopefully supporting them as they build back better in the future. And we have in the report contributions from over 20 GPIs, which you can read as well. Our discussions today have focused largely on central bank reserve managers. We haven't forgotten about the other constituents of the GPI community. And in fact, if you go to the website now, you can listen to podcasts from, for example, AP3 and CalPERS from the public pension funds, and there'll be more where that came from. For today, that wraps up what we're going to say about the GPI. There's a lot more that we're doing at OMFIF that might well interest you. On Monday next week, for example, we have a roundtable discussion on debt sustainability and the rebooting of development finance, very related to what we were talking about today. In early August, we have an exclusive roundtable with Eddie Yu, the Chief Executive of the Hong Kong Monetary Authority, on Hong Kong's role as a financial centre. In September, we will have our first ever Sustainable Policy Institute Symposium. We've got an incredible lineup of speakers at that. You should come and tune in ahead of COP26. And also in September, we have a Team Europe Borrowing Day that will involve the EU, the EIB, and also the ESM and other European sovereign issuers. And we've seen from the research that we've looked at today that they face some challenges in attracting what has always been a core constituent of their investor base as they continue to issue in record size in the bond markets. So for now, a few thanks. Thanks to all of you, wherever you are, for joining wherever you are in the world today. Thanks, of course, again to all the participants in our discussions today, as well as to Jean-Claude Trichet. Thanks to all the GPIs that contributed to the report and took part in the survey. We ask a lot of your time, but we hope you think it's worth it. But thank you very much indeed. Thanks also to the team here at OMFIF, across the research team, the policy team, those that wrote the report, those that have arranged today's session. It really is a team effort, and we're very proud of what we've managed to produce. And thanks also, of course, to our key sponsors from Amundi, from Bank of New York Mellon, and also from DZ Bank. And once again, just to reinforce the message, please do go and download the report. Thanks for joining us. We'll see you again soon.